Property is the hottest topic in Australia right now, and we've got the government proposing potential capital gains tax reform. In this video, I'm going to clear up some misinformation that is being shared by politicians and also some journalists. I'm then going to tell you why are they going to prosecute capital gains tax reforms? What are their public reasons? But I'm going to go behind the curtain and also introduce you in terms of the political reasons why they're doing this. We're then going to have a look at some of the proposals on the table, and then finally, I'm going to share with you what I think is the best proposal that's going to get the balance right. So let's get inside and let's take a look at the data. So why should my opinion matter? Well, I've got a lot of history in this space. Firstly, I've been an investor for over 30 years in residential property. I've also played an active role in the industry for over 20 years. I'm the current chair of the Property Investors Council of Australia, which is the PICA association representing 2.3 million property investors. I've also been on the board of the Property Investment Professionals of Australia, which is the peak trade association for the industry, and I was the chair for over 5 years of that association. I'm a qualified property investment advisor, I'm a licensed mortgage broker, and I also have real estate agent licenses in Victoria, New South Wales, Queensland, South Australia, and Western Australia. So that is my pedigree. That is the knowledge that I bring to the table, and that is why my voice has been well sought up from journalists and politicians and media throughout the course of the last decade. And there's 2 books that I've written on the subject with my co-author Bryce Holdaway, along with the #1 property podcast in Australia called The Property Couch. So that's the experience and knowledge that I bring to the table in terms of talking about this topic. So to start, I want to talk about the misinformation that's being put out into the marketplace from some commentators and also some political parties out there. And that is around when tax reform was introduced in 1999 in terms of capital gains tax reform, they said the property prices took off the back of this. Well, let's take a look at the data. As we can see here, measuring from 1980 to 2000, we saw that property prices increased by an average of 7.33% over that time period. If we then look past that time period, we can see that property prices have only increased by 7.07%. So they haven't actually increased. And if anyone understands how compounding interest and compounding returns work, they would understand that that's typical. But the myth is that property prices have exploded since that time, and the facts do not support that. So with that misinformation out of the way, let's now focus on why the government is going to introduce this reform. And this is the public messaging that they're going to share with you. Later on, I'll talk about the hidden reasons why they're going to do this. But the first point is around intergenerational inequality. And what we're referring to here is around home ownership. For young people and first home buyers getting into the market, the government is prosecuting this message that it's more difficult today than ever before in terms of getting into the market. Well, let's take a look at the data. What we can see here is home ownership rates by cohort as a percentage for the different age groups. So from 25 to 29-year-olds, in 1971 to 1981, around 50% of people owned or were buying their home. Fast forward to Census 2021, you can see that only 36%. So that's a shift of 14% over those decades. In terms of people who are 30 to 34, we saw 64%. And then we fast forward to the Census 2021, we can see only 50%. So that's another 14% change. 35 to 39-year-olds, that was 71% between 1971 and 1981, and that had dropped to 59% or 12% difference. And then finally, we'll just talk about the 50 to 54s. That was the peak in 1971 to 1981 at 80%. The peak year was 1996. And fast forward to the census of 2021, that's now 72%. So it's 8%. So in summary, we are definitely seeing lower numbers of first home buyers coming into the market at that lower age bracket. And some could argue that's got to do with the increased prices, and I don't disagree with that. It's definitely a lot harder to save a bigger deposit, and that's usually the number one barrier of seeing people get into the market. But there is also a couple of other things that have happened in terms of behaviourally and in terms of when we think about demographics that we also need to focus in on. And the first factor is in reference to median age of people getting married. So usually people are motivated to get a home if they're partnering up and starting to settle down. And so we can see here that we've produced this graph that will basically show that in 1971, the typical age of a male getting married was 23.8 years of age and a female was only 21.4. And if we move through that time cycle and we move into 2024, the typical age of a male getting married is now 32.8 versus a female, which is 31.2. Now, why are we bringing this up? Well, the reality is a lot of younger people are spending a decade where housing is not necessarily a major priority for them because they're living life. And the reason why they're doing that is also, we look at point number 2, is they're living longer. So let's go back to 1970, and the average female was living to 74.5 years, and the average male was living to 67.8 years. Fast forward to around 2024 data, and we can see that females have moved from 74 years of age to 85, and males have moved from 67 to now 81. So we're living longer. So we can now afford to have not just a gap year, but a gap decade. And so that is definitely playing in to the numbers that we're seeing. So we go back to the home ownership rates and we can see those people who are in that sort of 30 to 40 year range, the numbers of people who are buying homes is increasing during that time. Now, I'm not saying that it's not possible that housing affordability is a reason why they haven't got in, because that is true. But we also need to make sure that the data is reflective and the debate is reflective of changing behaviours and decisions that are being made by those younger generation. If we then overlay that with this other important data, and that is this data that we're talking about, first home buyer activity, we can see that it's actually not falling off a cliff. There are still a lot of people buying their first homes and coming into the market, and we know that the government's 5% deposit is helping with that initial barrier of getting into the market. But we can see there in 2009, an incredible spike, and then 2021, also an incredible spike. 2009 was post the GFC and the government incentives, and of course 2021 was record low interest rates, which means people's borrowing power and affordability could be measured at that time. But we are now starting to see again positive signals of more first home buyers coming into the market. So it's not like it's a dire position, but it's certainly not a favourable position for first home buyers coming into the market. So whilst political parties might be arguing this inequality story, there is more nuance in that particular story. So it's not a disaster, but it's certainly recognised as a challenge. The second point I want to focus in on is the government narrative around investors are crowding out home buyers, and especially first home buyers. It's the same argument that the Greens are prosecuting. So let's face it, there is no doubt that there is a major problem with housing supply. It is the number one problem. When you think about housing supply, you need to also think of it like this. Supply is the enemy of capital growth. And so if we want to keep housing affordable, we need to increase that housing supply. But what Jim Chalmers talks about is this whole idea that when an investor buys an existing property, they are crowding out a new home buyer coming into the market. Now, that is mathematically true, and it certainly doesn't add to supply if an investor is buying an existing property. But there are a couple of important points that we need to highlight here. Firstly, investors don't just buy existing properties, they also buy new. We see a lot of misinformation about saying that investors only buy 10% new and 90% existing. That is factually incorrect. What is actually happening is it's more like 65% is existing stock and 35% is new. And why is that? Well, if an investor is going into a market to add to the rental supply in that market, they can't wait for all the red tape and things like that for these properties to potentially be built. So that's one reason why we also buy existing over buying new. And the other important point here is that if we are buying new property, we actually add to supply in lots of other ways. Let me explain, because this is being missed by the mainstream media. The point I'm making here is that investors add to pre-sales of medium density, high density, and also subdivision developments. And it's those developers that need critical numbers of pre-sales to be able to go to the banks to get the funding to actually start the construction in the first place and get that development out of the ground. So think of it like this. You might have a medium density block of apartments where there might be 40 being built, but if they don't have those pre-sales, they won't be able to build the full 40. And that might be a mix of 30% investor, 70% new. So we have a net reduction in overall supply of new property coming online. So this idea that investors crowd out the market is not actually true based on that first point. Jim is also overlooking another really important point here, and that is when you actually look at the stock that is being delivered, that new stock that's essential that's being delivered, 90% of that stock is actually being delivered by small-time developers or mum and dad part-time developers. The other 10% is being delivered by the big end of town and the big construction and development companies, but the 90% of it is actually being delivered by those small-time developers. Think of it like this. Mum and dad investors, the 2.3 million of us out there, are adding hundreds of billions of dollars of investment into the residential property market. And it's that critical investment that adds fundamentally to supply. So be careful what we wish for in terms of if we're seeing a townhouse development or a medium or high density development. We're going to see less of that construction happening if we get these tax settings wrong. And finally, Jim Chalmers and his government is going to argue around levelling the playing field. So these are the taglines that they're going to mention. And is talking about this whole idea that tax settings favour investors over first home buyers and owner occupiers, and they crowd it out and they increase investor speculation. Now, Jim and the government, this is your best line. There is no doubt in my mind, from my experience, that this is your best argument. Right now, we are seeing very much too much investor speculation in terms of especially what's happening in the entry level of the property market. So I want to talk to that point. Investors do have an advantage over first home buyers when it comes to borrowing power. So explaining this in simple terms, as an investor, I can use rental income as well as my income that I earn through my exertion, my working income, and that allows me to have a greater borrowing capacity than, say, an owner-occupier or first-home buyer coming into the market who can just use their personal income. So this results in an unfair borrowing advantage. And in the hands of inexperienced investors who are also being seduced by countless social media posts about get-rich-quick in property, this is dangerous. And we absolutely need to put a stop to this. We need a sustainable property market, not a speculative market where we turn property into a trading commodity. But is reforming capital gains tax the only solution here? No, it's not. There are other ways in which we can improve the way in which we allow access to borrowing that evens the playing field. By way of example, APRA could introduce a policy that says you can't use rent as part of your borrowing assessments. That will reduce the number of people being able to rinse and repeat the number of properties that they're going to buy. So you don't need to reform capital gains tax to manipulate the market in the direction you want it going in. And to support the evidence around too much investor activity happening at the moment, let's take a look at this totality chart. And we can clearly see when you're looking at the average 10-year percentage of investors in the market versus what's currently happening, we can see that there is animal spirits alive and well in the property investment space at the moment, and that is definitely adding to the acceleration of property prices at the moment. So it's hard to argue With the reality right now in terms of levelling the playing field, there is very much a lot of active investors in the market and they're looking for quick wins. We need investors who want to play the long game, who want to invest in the decades and supply that critical rental accommodation as opposed to trading property and turning property into a commodity rather than a long-term investment. So that's a wrap for the public reason, but let's now go a little bit deeper on the political hidden reasons why. And the first reason is clear, and that is all about the debt and deficit, as this government has had record levels of spending. And so when we take a look at the underlying cash balance on this chart, we can see the problem that the government has got around the cash balance as a percentage of GDP. We can see here clearly that there is debt and deficit as far as the eye can see, so the government needs tax revenue, and they need it now. So that is something that they will be thinking about behind closed doors in terms of being able to rectify the current problem that they've got with their budget. And if this level of spending continues, then we're going to see higher inflation, because when government is a buyer, you'll always see inflation as part of that story. And then finally, off the back of that higher inflation, we're going to see higher interest rates. Now, no political party can survive in government with high inflation and high interest rates. They will be voted out. So it's really important that they get the economy on the right footings and start to think about the political consequences before the next election in 2028. And so this is one of the big challenges that the government needs to address around revenue shortages. When the government know they've got a problem, they obviously go to the pollsters and they try and see and get a read in terms of what's politically acceptable versus what's not, what's going to have a big voter backlash. Well, thanks to a recent political survey from Resolve, we see where they can potentially reform. So take a look at this. Now, the context here is important. This is a proxy because what the question was asked around, how could we fund extra tax cuts? And so we can see here, reduced spending is 66% of voters says yes, they would agree with that, and only 8% would disagree. Then increasing taxes on the banks or increasing taxes on mining companies. Obviously, politically that's low-hanging fruit because they're not all voters, they're companies. But I'm not sure that's the right thing to do economically for the long term. And then we move into negative gearing and capital gains tax. But with the mindset around increasing supply, negative gearing plays an important role here. Whereas capital gains tax, they're probably going to argue not so much. And so we can see here that reducing 50% capital gains tax, 40% of voters would agree with that, 42% are undecided, and 17% said that they would disagree. So when you start to think about the cohorts of voters and what sort of political impact you're going to have at the election box, that's where it's going to come into play. So it's important to understand that is this politically palatable in terms of making this change. And if there ever was a best time for the Labor government to do that, this is Labor's window. They have 150 seats in the lower house, and they also potentially have the support of the Greens to get it through the Senate. So this window is open for the government to make these policies. Because if we think about the capital gains tax and negative gearing reforms that they took as opposition to the 2016 and 2019 elections, both of those policies failed because they didn't get into power. But they're in power, and potentially they've got a majority government to push it through, with a window of the next election not being till 2028. So it sort of makes sense. It's going to be a now or never moment for them to consider capital gains tax reform. And off of the back of the mandate that the Labor government got, don't forget, last year Jim Chalmers corralled a group of thought leaders into an economic roundtable in August, and their job was to find new ideas around improving the economy, making the economy more productive. And what do we hear since then? Crickets. So the media pressure also on the government to act in terms of major tax reforms and getting our economy fit for purpose for the 21st century, nothing's being done of that. So that political pressure, that narrative from the journalists will continue on if they don't see any changes in the May budget. So that is an important hidden story that the Labor Party also needs to address. And that's why there's an enormous amount of pressure on the government to act now on tax reform. So in summarising the core objective, if you're sitting in the think tank of the Labor Party right now, these are the things that matter. You can't impact more future supply. So policy settings cannot afford to reduce the incentive to build more housing stock, number one. Number two, your policy settings need to make sure that it's going to increase revenue. And it probably needs to increase revenue reasonably significantly considering the spending promises and the debt projection that we've currently got. And then finally, it is a story of levelling the playing field. Those first home buyers want to hear that you're doing something about levelling the playing field between owner-occupiers and investors. So if you can nail that, you get your greatest gift of all, and that is staying in power. Because at the end of the day, that's what all these objectives is about, because the political parties believe that they want to stay in power because they've got more work to do. And they want to do it their way because they believe their way is the best way for the future of Australia. So that's the challenge, that's the objectives. It's now time to look at who's going to be impacted when it comes to any type of policy settings before we go into the actual policy proposals themselves. So thinking of our voters, who is going to be impacted? Well, let's take a look at the data to understand this. Here is a list of all of the breakdown of housing tenure. So we can see here we've got own with a mortgage, 35%, which is 3.43 million voters. Outright ownership, 31%, which is 3 million voters. We've got private renters, which is around 24.3%, which represents about 2.38 million voters. Then we've got renters in social housing representing 3%, very small portion. And then we've got renters in other community, and then we've got other tenure. So less than 1 million people in that cohort that we're talking about here. So the biggest cohorts are the 3.3 million plus the 3 million in terms of current homeowners. So that represents around 6 million voters. And then you've got really the renters, which is around 2.38, and you've got around 2.3 million investors who are also in there. So almost the investors and the landlords counterbalance themselves out, but so you've got this owner-occupied cohort. And so that's who I wanted to talk about first. What do they want? Well, in reality, they want this. They want their house prices to keep going up in value. At the end of the day, their house is their biggest financial investment outside of their future superannuation, so they do want the value of their house to go up over time. Now, some could argue, do they want it to rocket so their kids can't get into the property market? No, that wouldn't be the case. But the bulk of current owners do want to see the value of their property growing, and that will be in their back of their mind in terms of, will this policy impact house prices over the longer term, and or worse still, will it collapse the property market, which will be a complete disaster for the economy, but also a disaster for the government in terms of votes. What about first home buyers? What do they want? Well, ultimately, if they had their way, and it wasn't the reality that we currently find ourselves in, they'd like a McMansion as close to the city or on the beach or wherever they wanted to live. They want affordable housing where they want to live. The reality is that that's not how our economics work. That's not how land values work. And so in real terms, if you break it down, they want to have something that's practical to live in that they can also afford. So that's their basic needs accounted for. What about renters? What do they want? Well, it's true. The bulk of renters eventually want to be homeowners and realise their great Australian dream. But what the political narrative doesn't tell you is that there's also a lot of renters who don't necessarily want to one day have the great Australian dream, and they might be in different stages of their lives. So I think it's important that we just unpack this for a minute or two to explain the different types of renters out there. And we've got 3 different types of renters that we break this concept down into. Those 3 include not by choice, or by choice, or transit, or into transit in terms of their situation. So let's take a look at those in more detail. Not by choice, we're talking about they have no sufficient financial means to buy or own a property in their current situation. Natural disaster or damage to existing property, so they've been forced out of their dwelling. Escaping domestic violence is also another growing cohort, unfortunately. And then they might require specialist health care assistance and not readily available in all locations. So they're our not by choice categories. Then when we talk about by choice, and it's important to remember that this is the most significant category, we're talking about independence, moving away from home. So young adults moving away from home to have that lived experience. Recent arrivals in Australia, which is the new migrants, they will choose usually to rent, try an area before they buy. Better school options is a driver for a lot of people in terms of giving their children the best opportunity in the best public schools. Then we're talking about convenience. So they may want to live in a certain location within a city and it's more convenient for them, for their lifestyle, for their work, or for that balance that they're trying to strike. New friends or associates, building new networks, so share house experience, meeting new people. Then we're talking about people who might have sold homes and are then in transit looking for their future dream home. Then we've also got renovators who have chosen to, well, they've been forced to move out because of the structural renovations on their home, so they are going to be temporary renters, but they need maybe 6 months to 18 months as their extensive renovation gets done. So they are also by choice. You've got rentvestors who have been sold on the dream of renting where they want to live, but also building a nest egg by investing in other properties. So again, by choice. And then you've also got people who might be priced out of locations that they have a high desirability to live in, and so they choose to rent in that location and choose to invest their money elsewhere. So again, that's the most significant cohort here. Not everyone wants to be a property owner today. And then in terms of transit or transient people, and this is the quasi by choice or looking for work, so interstate migrants, they're moving for new job opportunities or new lifestyle opportunities. Relocated workers, they're on temporary projects, big infrastructure builds that require them to live in a particular location at any point in time. Remote workers, seasonal workers, backpackers who are extending on extended working holidays. So that's why I highlighted the point before. From economic dynamism, we do need to be able to have the ability to move populations around, because that's critical human capital that we need in those locations. And the Treasurer and Treasury and the government should know this in terms of why it's so important to have this ability to have adequate rental supply in a location to be able to see that location grow and thrive over time. And finally, what about our landlords, our investors? What do they want? Well, we do have data on this, so it's important that we put this data into the debate. And so let me share it with you. And this is coming from the PICA, Property Investment Professionals of Australia Annual Sentiment Survey, which has been running for over 10 years now. So let's take a look at the data to see what they're telling us. And I'll only focus in on the top 5 because they make up the majority of the reasons why investors invest. The first one is to provide financial security for themselves and or their families. 93% of the motivation is in that area. Secondly, to be self-funded in retirement, to pay their own way, to avoid the government assistance. 85% of people saying, I'm not going to be a burden on government in retirement because I'm going to be a self-funded retiree. Point number 3, or top number 3 point, is the retire early. Okay, so they want the option to potentially work less. So if they can amass a nest egg that's sufficient to, or passive income that's sufficient enough that they can retire early, that's attractive for those people. Number 4, they want to add to their retirement nest egg. So there's a lot of investors who own 1 or 2 properties. That's around 90% of the investor cohort. And that, in concert with their superannuation, should be enough for them to have a very, very comfortable retirement in the course of the next 2 or 3 decades. So not everyone is here to build a mass property portfolio like the Greens or maybe the left-leaning side of the Labor Party will have you understand. In terms of point number 5, this one here is a little bit of a dig at the government, but I don't trust the government in terms of being able to increase my superannuation or provide enough money for me in pension phase, so they are going to build their own nest egg, and that was 60% of the voters who voted that in terms of that survey. So there you have it. There's the top 5 reasons why investors invest in residential property. All right, in recapping that, remember, we've got current owner-occupiers, we've got first home buyers trying to get into the market, we've got renters, and we've got landlords. Now, the big challenge for the government, when you look at that voting pool, 2/3, i.e. owner-occupiers and landlords, make up 2/3 of that voting pool. And only 1/3 of that voting pool is first home buyers and also renters. But the government really does need to be doing something, and that's why they will act. So that's why we need to draw our attention now to the different policy suggestions that are out in the market. Let's start with the first policy proposal, because we know it's been around for a long time, but let's see if it was a good policy in the first place. And what I'm talking about is what Labor took to the 2016 and 2019 elections and lost both of those elections. And that was this idea to drop the concession from 50% down to 25% and grandfather it, meaning that obviously anyone of the investors who had a property, they wouldn't be impacted, they would still have the 50% concession. So let's run it through the lens in terms of what the objectives are. Does it meet the objectives? Because if you are going to grandfather it, what was interesting about those policies was this idea of this little window of when it comes into effect. They had about a 3-month window, which could have caused a buying frenzy and a rush for people trying to get into the market. Well, over those 3 months, property prices would have gone up. First home buyers would have definitely been locked out, during that time. And then you start to think about what's the long-term supply story here. Remembering that supply is the enemy of capital growth. So if we have lots of supply, you usually have slower growth. And start to think about this logically in terms of you've got greater population, so that's going to put underpinning demand in terms of housing supply in the future. So if we don't deliver that supply, then you're going to see higher property prices. Second to that, using the same principle, with immigration still quite strong, you're going to basically see a flow in of new people looking for rental accommodation. And so population equals higher rental demand. If we don't have higher rental supply, you're going to also see higher rents. So the problem with this policy is this: it doesn't deliver on extra supply and sustainable incentive for future supply over the long term. It also doesn't deliver on their revenue need, which is now. Okay, so if you're going to grandfather it, you're not going to get the billions of dollars of revenue that will come later on, but you need that revenue now. And finally, when we're talking about a level playing field, well, outside of that little window, sure, it will hopefully reduce the speculators, so we'll give you a tick there. But broadly, it's not going to do the job that's needed by the government to actually have a good policy setting that's sustainable for the broader economy and also for the benefits of those owner-occupiers, first home buyers, renters and landlords who is all going to be impacted by this policy. So let's continue on this theme of reducing capital gains tax concessions from 50% down to 25%. This time we want to look at the Grattan Institute, which has been calling for tax reform in the property space for a long time. In their case, their proposal is to drop the tax every year by 5% from 50% down to 25%. Now, what they're arguing is that this will avoid what's called the lock-in effect, which means you won't have this big shift in behaviour and attitudes and sentiment if you just taper it and do a staged approach in terms of doing that. So let's take a look at it through those lenses again. What does it mean for investors? It's going to still mean over time higher taxes, and so that's going to have a negative impact on overall supply. In terms of revenue, it's actually going to delay the revenue uptake by government because it's going to take longer for them to get to their peak revenue levels. And remembering, we've got a coalition government who's going to talk about debt and deficit and government spending. So that will be an Achilles heel in terms of 2028 for the next election with the Labor Party. And then finally, in terms of levelling the playing field, Well, by doing a staged approach, you've still got the property speculators who might be thinking that I can still trade property enough, and so you're not necessarily going to take those speculators out. So I'm not sure you're going to do anything about reducing property prices or helping renters with this type of policy. So in my mind, it's also a fail. The next policy under the microscope is now the concept of no grandfathering. So through some intelligence as we're going to air, we understand through reporting in the AFR, Australian Financial Review, that the Labor Party and Treasury are modelling a potential to reduce from 50% down to 33%, but no grandfathering, and potentially just on property, not necessarily on shares or other asset classes. So this is big news, but let's maintain our focus in terms of whether this is a good policy setting or not. So if the government announces this policy, let's take a look at what it does for supply. There will definitely be less incentive for investors on new supply. But furthermore, if anyone understands behavioural economics, you're going to see what's called loss aversion. So most people respond to loss, losing money, twice as badly as they respond to actually making money. So what you're going to see is a lot of investors are going to hold on to their properties where they might have planned to sell. So you're going to see this potential impact. And if that is the case, you're going to see obviously less new supply coming on. You're going to see, one good news is you might see more rental supply and more confidence in future rental supply. But there's definitely trade-offs, because when we also talk about the revenue story, there's a couple of problems with this policy. The first one is, even though there's no grandfathering, it means from day one the government's going to start collecting more tax revenue. But here's the problem. It's going to be a robbing Peter to pay Paul moment, because we might see less turnover, in other words, less selling, so less government revenue to the federal government, but also less turnover is completely counterproductive for the states. The states rely on turnover for stamp duty. It's their second biggest tax. So what really gain have we got? We've got governments screaming out, state governments raising taxes to pay for their debts and for their needs, or asking for the federal government, which doesn't have any money to be able to give to the states. And finally, when it comes to looking at the level the playing field, well, that's probably one area where it does do okay, because by making it 33%, there's going to steer money away from residential property and steering it into other asset classes, such as shares or other investments, which would have been critical for supply. So you want to be very careful about the fundamental behavioural changes that we're going to see here. Therefore, in the wash up of it all, it's a dud policy setting. Policy settings matter. They're going to really impact when it comes to supply. They're not going to get the revenue that they needed. And if it's only on property, you're going to see a flight to different asset classes where they're going to be able to get a higher concessional tax advantage. So it really is poor policy, and we hope that this policy idea doesn't see the light of day. So we've heard from the Labor Party, and we're seeing the sort of narrative that they're trying to prosecute with Treasury and doing the numbers now. We've seen the Grattan Institute's idea, but none of those are meeting the mark. Well, also there are a couple of other political parties in there. We know that the Coalition are advocating for no change under their new leadership, but I also want to spend a second to talk about the Greens Party. The Greens Party. I mean, their idea is to basically remove the 50% capital gains exemption altogether. Now, that is just plain stupid. If you're talking about the 6 million owners of property, that could potentially impact the value of their homes. They're not going to be super happy. If you talk about the renters, and the Greens Party say that they are the party of the renter, well, rents are going to go higher because there's going to be a lot less supply of rental accommodation. Or the Greens will say, well, the government needs to build it. Government's got no money, people. So that would just result in higher taxes for all of us to pay. So the Greens policy is the most stupid policy on the table. So it's not even worth considering, more than saying no, let's move on. But it does bring me to this whole concept of the change that occurred. And that is around, in 1999, we saw this change coming in where we're indexing, we were calculating inflation, and your income was going to be adjusted, or your gain was going to be adjusted against inflation. So we're seeing a lot of the debate focusing in on that inflation hasn't kept up with the gains that are being made with this 50%. Well, that's only half of the argument. So a lot of people are missing that. So I just want to bring you up to speed with the two reasons, because it wasn't just one. It wasn't just accounting for inflation and making the process a lot easier. It was also about income wage averaging, because the problem with the current setting is, and the reason why they went to the full 50%, is if you calculated as the 1 year in which you sold the asset, then you potentially don't get income averaging over that time. So if you move through the wages in terms of your PAYG and you're on the highest pay rate, it doesn't accommodate for that income averaging, which would have meant you would have paid less tax. So they were the two reasons. Indexation, making it simpler, and then the second one was income averaging over time. Just felt it would be fairer for that individual in terms of any gain that they're made. So that rounds us out to finally the big promise. Here we are. We're going to talk about a policy that I believe has the greatest merit in terms of providing the most amount of wins across the board, from political to making sure that you're appeasing the first home buyers, to making sure you're seeing supply come in, to making sure you've got future investment from investors. This is the right policy settings where you get the balance right. So let's look at it. Here we go. So as we can see on this table, this is how it would work. From 0 to 1 year, you get the 0 discount, which is common right now. But from year 1 to year 2, you get the 10% discount. From year 2 to year 3, you get a 20% discount. From year 3 to year 4, you get a 30% discount. Year 4 to year 5, 40%, and greater than year 5, you get back to that 50% that accounts for inflation, but it also adjusts for what we've just learned about, which is the income averaging. So it's fair up for the investor in terms of the returns and the ultimate tax that they will pay. So let's unpack how this has so many positives and very few negatives in terms of why it's the right policy setting. So the best way to look at the benefits is let's look at the different people and cohorts that are going to be impacted. So let's start with current owner occupiers. The good news for them is they're not going to be panicked about significant market corrections through potential radical tax reform changes. So the value of their property is going to be maintained, and hopefully it'll have sustainable growth rather than this rapid growth that we're seeing. So a tick for current owners. Let's turn our attention now to first home buyers. First home buyers will now love this idea because at the end of the day, the speculators, the property flippers, they will hate this idea. This is going to cause them a lot of grief in terms of coming into the market in the future. So it's going to level the playing field for those first home buyers coming in. We know the story that, these speculators or flippers, they'll come in and we love the area that we want to buy in and it's an affordable home in a great area, but then a flipper buys it and then they renovate it and then they sell it for profit. And as first home buyers, we were hoping to get that property, do it up and make our memories in that particular home. So they will love this idea in terms of less competition from the flippers and the speculators. Renters will love this idea because it will add to rental supply. We will not see the investor pack up their bags and leave this market. They'll continue to add to supply because they have the fundamental thing that they need, which is confidence in no further rule changes. They don't want the rug pulled out from under them. So the investors will continue to keep investing tens of billions of dollars annually, not the government, but the private investor will keep doing that. And so that will keep rental supply high and that will keep rents down. And from the landlord's point of view, well, the true investor. So we've separated out the trader speculator from the long-term investor. It's business as usual for them. So they're going to go about buying 1, 2, maybe 3 properties, hold them over the long term in concert with their super, and they're going to meet their objectives, which was around financial security for themselves and their family, and be self-funded retirees. So you can start to see the message that's in here. And then finally, we'll talk about the government. The government is going to get their revenues because this policy kicks in from the night of the budget. So it means that anyone who is a trader and who is a speculator, they have not really added to the social good that lots of long-term investors do in terms of providing adequate rental accommodation. So they are going to get slugged with higher taxes from the next day, and that delivers stronger tax revenues for the government, for those spruikers and traders. And if they want to keep doing it, they've just got to pay a higher privilege for that in terms of paying higher taxes. So we see immediate increase in tax receipts from those people who are playing in that space from here going forward. So that's why we like the policy. Politically, it works well as well. So when we talk about the 2/3 of the cohorts, well, if you're keeping the current owner occupied happy and you're keeping the 2.3 million property investors happy, you're going to get 2/3 of the population happy. And if renters know that there's going to be reasonable supply in the future, you're going to hopefully keep them happy. And the first home buyer, you've got a good story to tell them about taking the traders and speculators out, but making sure economically we have that adequate supply of rental accommodation for human mobility, which I talked about before, in terms of driving economic growth to our regions and in terms of driving economic growth into our cities, because we can't buy new because there's too much red tape to quickly build new supply. So also being able to buy that existing property by not changing the rules from new to existing is also a political win for you. So there you have it. That is the best policy option for the government to consider. If you agree, then share it with friends and family. If you want to debate it, you now have the adequate amount of information that you need to be involved in that debate. It is an important debate. Make no mistake. This is the biggest political discussion point in years. This reform has been touted for over a decade, and this is the window in which Labor will be prosecuting their case. But this is the best policy settings. If they opt for those other policy settings, they are going to get the unintended consequences which I talked about. So again, if you agree, like this video. If you've got other ideas, add it to the comments below. If you're listening to this, share it to your friends, family, loved one who will be impacted. Housing impacts everyone in this country. So it's important that we have the right debates, and it's important that government also engages with the property investment sector. We've seen very little engagement. They engage with the big end of town, the big associations that don't just specialise in residential property. They need to be engaging with the Property Investment Professionals of Australia or the Property Investors Council of Australia, of which I'm the current chair. And for the record, that is our policy. That has been our policy since late 2019. So what do you think? Share your comments below, like it and subscribe, and hopefully we can continue to keep educating you on these important property decisions.